A significant shift in global economic relationships is drawing attention from markets, industries, and analysts around the world. As countries adjust trade partnerships and resource strategies, the impact is being felt across energy markets, manufacturing hubs, technology sectors, and global supply chains, ultimately influencing prices, capital flows, corporate strategies, and economic stability. We are living through a period of transition that some analysts describe as the most consequential since the end of the Cold War or the emergence of China as a global economic force. Yet, unlike previous turning points, today's changes are driven less by a single global narrative and more by a complex interplay of geopolitics, technological competition, climate policy, demographic shifts, and evolving consumer preferences. To understand how markets are reacting, we must explore these forces in detail and examine how the structure of global partnerships is being reshaped. Over the past decade, the geopolitical balance of economic cooperation has shifted. Nations are increasingly wary of overdependence on single sources for critical goods, especially after supply disruptions caused by pandemics, geopolitical crises, and export restrictions on key technologies. As a result, countries that once pursued liberalized trade with few restrictions are reconsidering past assumptions. For decades, globalization was driven by the idea that integration benefits all, that goods, services, and capital should flow freely, and that comparative advantage would optimize global welfare. However, rising tensions between major economic blocs, concerns over intellectual property security, and strategic considerations around critical industries have led to what some describe as managed interdependence. In this environment, governments no longer see open markets as an unconditional good. They see them as strategic terrain. This change is not occurring in isolation. It is affecting how nations choose partners for trade agreements, where they locate manufacturing facilities, and even how they define national security in economic terms. One of the most noticeable effects on markets has been the reconfiguration of trade partnerships. Countries are negotiating agreements not only based on traditional economic calculations, but also on strategic resiliency. Take, for example, energy markets. Nations that historically relied on a narrow set of energy suppliers are expanding their networks to include alternative sources. This shift is being driven by multiple factors: concerns over political instability in supply regions, decarbonization goals, and the drive to secure energy independence. As a result, new alliances are forming around renewable energy investments, liquefied natural gas, LNG infrastructure cooperation, and shared research into next-generation energy technologies. Markets respond quickly when traditional supply channels are disrupted or reoriented. Firms in sectors such as oil, natural gas, and clean energy technology have experienced increased volatility as investors try to price in the implications of long-term shifts in supply dynamics. Companies that once thrived on long-standing agreements with dominant suppliers are retooling strategies to compete in a landscape defined by diversification and flexibility. In manufacturing, the pursuit of diversified supply chains has accelerated the trend toward regionalization. Instead of spreading facilities across continents in pursuit of the lowest possible labor costs, many manufacturers are now prioritizing closer proximity to consumer markets and political allies. This shift is hitting industries like automotive, consumer electronics, and pharmaceuticals especially hard, not because demand is falling, but because the cost of reconfiguring production networks is high, and the timeline for change is rapid. As production hubs move or multiply, markets must reassess cost structures, pricing expectations, and competitive dynamics. Equity markets, bond investors, and commodity traders alike are adjusting to a new paradigm in which global integration coexists with strategic decoupling. Global supply chains have historically been optimized for cost efficiency above all else. Just-in-time inventory systems and concentrated production in low-cost regions like Southeast Asia became commonplace. But the disruptions of recent years, from global pandemics to geopolitical conflicts, exposed vulnerabilities in this model. In response, firms are rebalancing their supply chains for resilience. Many are adopting a multi-hub strategy, creating backup production facilities and diversifying suppliers across geographies. What this means for markets is profound. For commodities, demand patterns are shifting. Countries that once imported most of their raw materials are now investing in domestic or regional sources. This change triggers price movements across metals, rare earth elements, agricultural products, and energy inputs. Investors are recalibrating commodity risk premia as supply becomes more fragmented. In manufacturing, investors are watching capital expenditures increase as firms invest in new facilities, automation technologies, and logistics infrastructure. These investments are reshaping valuations in industrial sectors and altering expectations for long-term earnings growth. In consumer goods industries, companies are restructuring relationships with major suppliers. Contracts are becoming more flexible and shorter in duration, reflecting uncertainty about long-term trade conditions. Markets are interpreting this as a sign that some companies expect continued turbulence rather than a return to pre-existing norms. One of the clearest arenas where changing global partnerships are affecting markets is the technology industry. The geopolitical competition around advanced technologies, including semiconductors, artificial intelligence, quantum computing, and telecommunications infrastructure, is redefining alliances. Governments are imposing export controls on sensitive technologies and are incentivizing domestic production through subsidies and tax incentives. Companies in these sectors are reallocating investment, often under government direction, to align with strategic priorities. Investors are responding accordingly. Valuations of semiconductor firms, cloud computing companies, and AI innovators have been influenced not just by earnings prospects, but by geopolitical positioning and supply chain security. The semiconductor industry, in particular, illustrates this dynamic vividly. Chips are a technology underpinning nearly every modern device, yet production capacity is highly concentrated in a few regions. Policy shifts encouraging onshoring of fabrication plants have triggered significant capital commitments from major players as well as new entrants. This has ripple effects in equipment, materials, and software markets tied to the semiconductor ecosystem. As technologies become more central to national security considerations, markets are pricing in a future where innovation leadership is tied to access, not just raw technical capacity. Tech firms that are seen as aligned with strategic partners are trading at premiums, while those caught in jurisdictional uncertainty face increased volatility. 5. Monetary policy and currency dynamics respond. The changing structure of global partnerships also interacts with monetary policy and currency markets. As nations pursue more self-reliant economic strategies, central banks are paying closer attention to external vulnerabilities. In countries seeking to attract investment into strategic industries, monetary policy may prioritize stability over inflation targets. At the same time, currency valuation pressures emerge as trade imbalances shift. Some nations, particularly those pursuing export-oriented strategies, intervene to maintain competitive exchange rates. These shifts in monetary policy complicate the task of financial market participants. Traders in currency markets must now consider not just macroeconomic fundamentals, but also how geopolitical alignments influence foreign exchange flows. For example, as nations deepen economic ties with certain regions, capital flows tend to follow, strengthening currencies associated with those partnerships. Bond markets, too, are sensitive to these changes. Sovereign credit risk perceptions evolve when fiscal policies are adjusted to support strategic industries. Investors weigh the trade-off between short-term fiscal strain and long-term economic security, influencing sovereign yields and credit spreads. 6. Inflation, costs, and consumer markets. As global partnerships change, one of the most tangible effects on everyday life is inflationary pressure. Even before the recent shifts, inflation had already been elevated in many economies due to pandemic-related disruptions. Now, as trade relationships adjust and supply chains are restructured, the cost of goods is being affected. When supply becomes more fragmented and less efficient, production costs typically rise. These costs are often passed on to consumers in the form of higher prices for food, energy, electronics, and other essentials. Consumers are already feeling this impact, and markets are closely watching inflation data for signs that price pressures may persist or even accelerate. Central banks, already navigating a delicate balance between controlling inflation and supporting growth, are forced to remain vigilant. Interest rate decisions now factor in not only domestic data, but also global supply risks that could push prices higher independent of monetary conditions. Higher consumer prices also influence corporate behavior. Companies with strong pricing power, often those with dominant market positions, may benefit from inflationary environments by maintaining margins. Small businesses, on the other hand, struggle to absorb rising input costs and may be forced to raise prices, reduce output, or delay investment. Primary market reactions include shifts in sectoral performance. Consumer staples and energy sectors often outperform during inflationary periods, while sectors tied to discretionary spending face more pressure. 7. Capital markets are reallocating risk. Investors respond to changing economic conditions by reallocating risk across asset classes. In the current environment, where global partnerships are realigning and uncertainty is elevated, capital is moving in distinctive ways. Risk-averse investors are flocking to safe haven assets and diversified portfolios. Governments with strong fiscal positions and stable partnerships attract capital, while those with weaker strategic alignments see investment flow out. Equity markets in nations perceived as strategic hubs for technology and manufacturing have shown relative strength, reflecting investor confidence in long-term growth prospects. Meanwhile, bond yields are adjusting to reflect both inflation risks and sovereign credit considerations. Companies with high debt loads or those dependent on global supply chains face increased borrowing costs as lenders price in uncertainty. Private equity and venture capital are also adapting. Instead of funding long supply chains with low barriers to entry, investors are allocating more to companies offering resilience, such as digital platforms, automation technologies, biotechnology, and renewable energy. These sectors appeal because they are seen as less exposed to traditional geopolitical risk and more aligned with future growth. 8. Climate policy meets economic strategy. Climate policy is another driver of changing partnerships. The global transition toward decarbonization has created new alliances centered on shared commitments to reduce emissions and accelerate clean energy technologies. Countries are signing cooperative agreements to develop green infrastructure, share clean tech innovations, and fund large-scale renewable projects. These partnerships are not purely environmental, they are economic and strategic. Nations that can lead in the production of clean energy technologies, such as solar panels, batteries, and hydrogen systems, stand to capture significant market share in the decades ahead. Investors are noticing. Markets for climate-aligned assets have surged, and firms that can demonstrate clear pathways toward carbon reduction and alignment with global climate goals often enjoy favorable valuation multiples. Meanwhile, industries facing transitional risk, such as traditional fossil fuel producers, see capital costs rise as investors shift toward greener opportunities. The intersection of climate policy and global economic strategy further complicates traditional trade relationships. Some nations use environmental standards as leverage in negotiations, while others seek exemptions to protect emerging industries. These dynamics influence tariffs, carbon border adjustments, and investment flows, all of which feed back into market pricing. 9. Future outlook. What comes next? So what does all of this mean for the future? The short answer is that markets will continue to evolve as global partnerships change, and the implications will ripple across every corner of the global economy. In the short term, price volatility should be expected. Commodities, currencies, equities, and bonds will all react to news surrounding new trade agreements, supply chain shifts, diplomatic developments, and policy decisions. Investors will need to be nimble, adaptive, and forward-looking. In the medium term, structural change will continue. Supply chains will become more regional and resilient, not necessarily more efficient in a cost sense, but more reliable in a strategic sense. Technology industries will bifurcate into partner networks defined by shared regulations and security standards. Energy markets will diversify sources, placing a new premium on renewables and critical minerals. And in the long term, economic growth may become less about outsourcing and more about strategic competitiveness. Countries that can innovate, adapt, and build partnerships based on mutual benefit will unlock new opportunities. Markets will favor firms that understand this new landscape and can position themselves not just as participants in global commerce, but as architects of future economic networks. Final thoughts. The global economy is not shrinking, it is reorganizing. Markets are not retracting, they are reallocating. The transformation we are witnessing is messy, uneven, and sometimes unpredictable. But it is also full of opportunity for those who understand the forces at play. As governments, corporations, and individuals navigate these changes, the ability to anticipate shifts, understand geopolitical context, and adapt strategies will be essential. In the coming years, success will go not to those who long for the stability of past paradigms, but to those who embrace the complexity of a new economic order.